Hi and welcome to the Vinva Systematic Equities Portfolio Update. My name is Martin Van Eyck. I'm part of the Magellan distribution team. I'm here today joined by Lead Portfolio Manager Trent Larcombe and Executive Director and Portfolio Manager Nick Burt. Welcome Trent, welcome Nick. Okay Trent, starting with you, with the global equities, can you give us a bit of an update on how the strategies have performed over the past quarter? And maybe any stocks or anything that's particularly stood out over the last couple of months?
Sure, Martin. Yeah, so we obviously had a fairly volatile Q2. I think markets dealt with the trade war and Liberation Day on April 2nd. So I think we saw the broader market in the US go down 10% intra-month. But funnily enough, it closed sort of up 1% in April. So a big turnaround there. And then, and then markets really kicked on in May and June. So yeah, global developed markets were a really good performer over that quarter. With regards to our global funds, we saw some really consistent performance carrying on from Q1 actually, where all months throughout Q2 we outperformed the benchmark across all of our global portfolios, where we saw some really good outperformance. Whilst we don't take large country bets or sector bets or single stock bets, we did see some really good outperformance in the US after it sort of struggled actually in Q1. So really good to see that bounce back in Q2 from the US. And in the other regions in EMEA also positively contributed to our global portfolios, and Asia Pac was small down. So I think generally, across the board, I think, the financial sector, the industrials, both performed really well from a sector perspective. Again, they're not significant bets, but breaking that down, it did well. I think the only sort of broader sector where we underperformed was in the IT sector, so which was really good to see. Single stocks, no huge contributors across the board. As I mentioned, fairly small bets within the portfolio. So overall, a really consistent performance, across the quarter. To be up, I think, in each of the months in a very sort of volatile period, both geopolitical, and as I said in the markets, it was a really good and pleasing performance from the global funds for us.
Okay, fantastic. And Nick, switching over to you and the more locally Australian-based, stocks, how did you find the quarter? What stood out for you? Anything in particular?
Yeah, interesting, as Trent said, it's over that sort of quarter, there was a lot of geopolitical events that were occurring. We had the tariffs at the start of the quarter, we had the 12-day war, and then we sort of ended up with the big, beautiful bill towards the end. Yeah. So there was a lot of geopolitical events during that quarter, and Australia, with probably a little bit more exposure to the resources and materials sector, experienced a little bit more volatility. There were some big moves, particularly around sort of the energy sector with the war that was going on between Iran and Iraq. You then also had sort of uranium prices moving quite rapidly, and also sort of the rare earths, which was related sort of to the tariffs introduced. So there was a little bit more volatility. It wasn't as consistent as the global strategies. Despite all that sort of volatility, we still managed pretty strong returns. In terms of the overall sort of stocks, it's important to note with our strategy is we don't take large positions. So we take a lot of little smaller positions. The biggest position in the portfolio is only around 3%. So you never expect to have these sort of huge stock-specific events where you can have one or two stocks driving the portfolio's return. So we had a really good spread of performance across the portfolio. Two particular standouts, but still made up less than 10% of the overall sort of alpha was sort of 360, which is continued some rapid expansion in the US, and also IDP or IEL education, okay. Which more of an industry dynamics there has really sort of struggled in that sort of space, and we've been underweight, was a good performer for us as well.
Now, Nick, staying with you, part of the Vinva investment strategy is looking for signals or looking at signals that identify alpha opportunities. Can you provide an example, particularly relating to where the shorter term signal generates that alpha and requires maybe more quick action compared to like a longer term signal potentially indicating like future alpha opportunities, maybe necessitating trades and positions further down the track?
Yeah, I mean, with you look at our sort of strategy, we have a good breadth of signals across different thematics, in terms of behavioural type signals, linkage models, quality, valuations. We also have sort of what we consider breadth across also time horizons. So we have some signals which are very short horizon, some mid horizon, some are long horizons. When we're talking about short horizons, we consider, any signal that basically is forecasting returns over the next sort of 5 to 20 days is what we consider short horizon. They are generally higher turnover, so we don't have a high weight to those particular signals. They're quite hard to trade and they can be expensive in terms of transaction costs. So it's a relatively small weight, but we do have a suite of signals which basically are trying to, maximise our opportunity set across both fundamental mispricing and also any transient mispricing that may be happening in the short term. So we look at very short horizon sentiment type signals as a good example. Other information we may look at on the short horizon is very flow orientated type data and trying to see sort of recent flows which may persist over the next sort of 3 to 5 days, and we take advantage of that.
Okay.
Now, it's important to note when we do trade these sort of short horizon signals, that's where our portfolio construction process really becomes quite important, because you need to know, as I mentioned before, sort of the transaction costs and also the what we call round trip transaction costs. So if it wants to buy the stock now and sell it in 5 days' time, you need to know the transaction costs getting in and getting out. So it's calculating that round trip transaction costs and optimally deciding whether or not it's worth doing that trade or not. So when you actually look at the overall portfolio construction and our sort of trade path, quite often a lot of these short horizon signals end up being more like actually timing signal or a trade timing signal than actually a pure alpha signal. And what I mean by that is, for example, if we like the stock on long horizon signals, so it's good value and it's good quality, yet the short horizon signals are looking quite negative, so we're expecting negative returns over the next 5 to 20 days. If it's a very illiquid stock and there's large transaction costs, it's not going to try and capture that. But what it's going to do is delay actually buying that stock, because it knows in the near short-term future, the opportunity is probably not there, and we don't need to rush in there and try and buy it on a valuation or quality type basis.
And what happens on the back of that, I think, is that it's worth noting in the short-term side of things, if we've got some indications from our shorter horizon signals or insights where we've seen an increase or a decrease, by factoring in the all-round T costs, that might override that forecasting of the stock, and we might not actually do that trade at all because of what that cost is doing to the overall forecasting power.
Okay, well that leads me into my next question. So with systematic funds generally, they're often seen as having high turnover of stock. So do you, Trent, in this case with Vinva, how do you see that with you guys and with your portfolios, and then how are the, after-tax returns impacted from that?
Yeah, I think the high turnover number is probably a little bit misleading. It's probably more about the distribution of turnover. I think within the portfolio construction process, what ends up happening is that there's quite a decent portion of the portfolio that remains quite static. It doesn't move too much, where a majority of the turnover happens in a smaller portion of the fund. Of our insights, I think we're looking to sort of, most of our gains come from sort of the longer term signals and insights that Nick referred to, rather than the shorter term gains. So what we end up finding is we're doing a fair bit of tuning or tweaking of positions rather than initialising or closing down positions.
Okay, fair enough.
It's important to note, like headline turnover numbers, they can be very misleading when trying to look at the sort of the tax drag, as Trent sort of mentioned. So it assumes, if you're looking at turnover, that every trade that you do is actually a tax event and it's a capital gains or a capital loss. But as Trent mentioned, depending on our signals, because we do have those longer horizon signals and shorter horizon signals, if we are trading towards sort of fundamentals, a lot of the time we're just accruing positions rather than actually realising. So, as I said, that headline turnover number can be very misleading when it comes to sort of tax, and based on from what a lot of clients have actually expressed to us is, our after-tax outcomes have been very strong.
And what we can see from within that portfolio construction process, we have a T cost for every stock, for every trade that comes out of the construction process. So Nick and I are aware of those costs from a single stock perspective, and we can monitor those during the day as we execute those orders in the marketplace.
Thanks, Trent. Thanks, Nick. Thank you for watching. If you would like to find out more about Vinva's portfolios, please contact myself or any of us at the Magellan Distribution team, and please feel free to share this with your colleagues as well.